Welcome, my name is Elizabeth Moran and I'm presenting this Bond Essentials webinar. First, a little bit about me. I'm a nationally recognised fixed income expert and have been passionate about educating investors about the fixed income asset class for many years. I'm currently Editorial Director at Fixed Income News Australia and Income Strategist at Intelligent Investor. I have also written a column for the Australian newspaper for over 7 years, been quoted in or appeared on all the major media outlets. I've presented at investment conferences across Australia to financial advisors and high net worth individuals, and I've even written 2 books on the asset class. So I'm very pleased to be given this opportunity to partner with Income Asset Management to present these educational webinars. This is the Bond Essentials webinar, which offers general information only. The webinar is entirely educational. There are no products or recommendations. Please do your own research before you invest and read the Financial Services Guide and Product Disclosure Statement before making any decisions. Today I'm going to be covering these 9 topics. First, the oldest living bond, then key bond characteristics, why invest in bonds, risk versus return, 3 types of bonds, a simplified bank capital structure, key risks, ways to invest, and next steps. The oldest surviving bond was issued by the Dutch government more than 400 years ago to help it build its canal system. It's really interesting because it was written on goat skin, and this is now held by Yale University as a relic. Every few years, Yale University go back to Holland to collect the nominal interest payment. It's really very interesting. If you'd like to hear or learn more, there's a YouTube video that you can watch. One of the most important things to remember about bonds is that they're a loan and they are a legal obligation. The issuer is legally obliged to pay interest when they say they're going to and return principal to you at maturity. Now, bonds are issued with a $100 face value and they're tradable, so that bond price can go up and down. So that means you can sell for a profit or a higher than expected return, but you can also sell at a loss. But the really great thing with bonds is as long as that company survives, at maturity, they will return the $100 payment back to you. So that capital preservation is one of the key reasons that people would invest in bonds. Bonds are tradable, as I mentioned, and that means prices do go up and down. Bonds have coupon payments. They're actually the interest payments. If you look at the diagram on this slide, the orange diagram, the top part describes the bond, and below there are little rectangles. These little coupons were cut off and given to the issuer for interest payments, and that is why in bond terms we call interest payments coupons. The other really important thing to note about bonds is that bonds are always lower risk than shares in the same company. One of the main reasons investors buy bonds is for diversification. You're diversifying away from high-risk asset classes such as shares and property. Within the fixed income asset class, there's a really wide range of securities available, and they're issued by many different companies and governments, different currencies and different types of bonds. So that diversification is really fantastic for your portfolio. Bonds, when they're first issued, have a $100 face value, and the issuer guarantees to pay you that $100 face value at maturity. So you're getting some capital preservation into your portfolio. You're assured of that capital being returned to you as long as the company or the entity continues to survive. Bonds are fantastic for income. Fixed rate bonds pay half yearly and floating rate bonds pay quarterly, as do inflation-linked bonds. And unlike shares, it depends when the bond's issued as to when you get your coupon payment. Bonds can be issued on any business day, and so coupons can happen on any business day. So you can get this constant stream of income especially if you're in or near retirement, which can be really useful for your portfolio. As I mentioned before, bonds are tradable. So if your view on markets changes, or if you need capital, unexpectedly need capital, you can sell your bonds within a couple of days, assuming there's a buyer, and that money will be in your account. One of the other big attractions for bonds is that they can help you sleep at night. They can be set and forget instruments. You don't have to be worried on a daily basis if the price has gone up or down, because you have that certainty of the income and also of capital being returned to you at maturity. Bonds are the only asset class that will provide a cushion for your portfolio when high-risk asset classes such as shares and property underperform. They have what's known as a negative correlation. So when shares underperform, bonds do perform and provide that cushion for your portfolio. In this graph, shares are represented by the dark blue and bonds by the pale blue. Have a look at the middle section where you can see 3 significant losses in shares. In all 3 of those instances, bonds performed and helped protect overall returns in the portfolio. There's only been 2 instances in the rolling 6-month period over the last 30 years where they haven't been negatively correlated. So bonds actually provide a highly efficient return for relatively low risk. There are 2 ways companies fund themselves. First is by issuing shares, and this is known as equity. If you're an investor in shares, you're looking for the company to grow. You want to see the share price grow and you want to see the dividend price grow. Now, the second way companies fund themselves is by borrowing money. This can be from banks or receivables, creditors, but once companies are big enough, they can actually borrow direct from the market and they can issue bonds. If you're thinking about investing in bonds, you're looking for that regular income because it's a loan and you're looking to be repaid at maturity. You're not actually concerned about the things that equity investors are. Your concern is survival. You want the company to survive so that they're going to pay you your interest and your principal at maturity. Whether they grow or not really doesn't matter. Big, consistently earning companies that aren't growth companies are actually very good to invest in as a bond investor. It's really important to note that debt investors are repaid ahead of equity holders. This is a really important graph. It shows the risk-return trade-off. Lower risk investments such as cash should have lower returns, while higher risk, more volatile investments like shares should have higher returns. You can see here cash is at the low end of the scale. Then the next level is fixed interest. Fixed interest is the next best thing to cash. It has slightly higher volatility and slightly higher returns. It's a defensive investment. You'll see right on the far end is international shares. If as an investor you were always wanting to invest in the highest risk securities, you would invest in international shares. But that would leave a lot of volatility in your portfolio. As you age, you really want less volatility. You want to protect your nest egg. And I think that's a time to invest more in lower risk assets, such as fixed income and cash. So, who issues and who buys bonds? Global governments issue and buy bonds. In Australia, all the states and territories also issue bonds, as do our largest companies. In terms of buyers, big superannuation companies, insurers, banks, they're all quite significant buyers of bonds in the market, but also high net worth individuals are also buying into this market. There are 3 types of bonds. The first is a fixed rate bond. It's a very defensive investment because it pays a fixed return for the term of the bond. Each half year you get a payment and you know exactly what that payment is. But what happens when markets change, when market expectation of interest rates change, the only way the bond can show this is through the price. So fixed rate bond prices move up and down to reflect the market. So if you think we're in a rate cutting environment and rates start to move lower, investors will be attracted by the high fixed return on the bond, and they will buy more of the bond, and the price will rise so that eventually the return on the bond then meets market expectations. But the opposite is also true. If interest rates start to rise, the bond price will fall and you can potentially incur a loss if you decide to sell before maturity. These are great investments at the top of an interest rate cycle and are very protective of the income in your portfolio. The second are floating rate bonds. Just as the name suggests, the interest or coupon payment goes up and down with the economic cycle. These bonds pay quarterly interest, and each quarter the issuer looks at the bank bill swap rate, which is a typical benchmark which moves up and down, and they readjust interest for the coming quarter based on that bank bill swap rate on that date. So as an investor, you accept that your interest payments will move up and down. Now, these particular bonds are very good in a rising interest rate or an inflationary environment, because interest income will naturally rise when interest rates rise. But they're not so good if interest rates are starting to fall, because potentially you can lose income. They are more capital stable than the fixed rate bonds, so there's quite a lot of difference in those two investments. The third is an inflation-linked bond, and these bonds are linked to inflation. The capital's linked to inflation, and so are the coupons tied to inflation. But there is a fixed rate component to them, so they also take interest rate risk, and that's a really important point to note. This slide shows a sample fixed rate bond coupon. Now, the bond was issued by Challenger and paid a fixed rate of 7.186% at first issue. So if you look at the time scale there, on the far left, you invest $100. Then after 180 days, we're paid $3.593 per $100 invested. And then every 6 months, that same payment is made until maturity, when you also get another interest payment, but your $100 capital is returned to you. Now, as an investor, if you buy bonds, you're the beneficial owner of the bonds, but they're held in custody with a licensed custodian who administers them on your behalf. Even large bondholders have a custodian. Now, here we have what I think is the most important slide in the whole presentation. It's what's known as a simplified bank capital structure, and it tells us the priority of payments in liquidation, so that if a bank was to get into difficulty and there were asset sales, it tells liquidators how to apportion those sale proceeds. And you start at the top, and you'll see there's different levels here. So each level must be repaid before subsequent levels can have any of that return of capital. In the diagram, it shows 3 levels of bonds and 5 levels of fixed income. But let's work our way through it. So starting at the top, senior secured bonds or covered bonds are very, very low risk securities, and they are actually secured by an asset pool. If for any reason those assets, the value of those assets declines, the bank's required to top up that pool. So this is a very, very low risk pool and typically AAA rated. Next, you'll see we have deposits. Now, deposits have an Australian government guarantee, $250,000 per entity, per institution. But outside of that, if you have more money in a single institution than that, it would go into this priority of payments structure. And deposits don't actually have any underlying security, and that is why they rank below the covered bonds in this priority of payments structure. Then we have senior unsecured bonds. Now, these bonds can be fixed or floating or inflation linked and might be issued for 5 to 10 years, but there is no underlying security. Investors are paid their regular income and they expect return of principal at maturity. Now, as we're going down the structure, the terms and conditions of each of the securities is changing and you are taking on more risk. So you actually expect to be paid more. So subordinated debt, the next level, these bonds again can be fixed or floating and are issued for what's known typically as 10 years. But there's a call date of 5 years. So 5 years is the term that investors expect to be repaid, but the securities can go for 10 years. So because there's that extended term to maturity, and with an extended term to maturity, there's greater uncertainty, as well as dropping down a level in the capital structure, you expect a reasonable pickup in spread for those securities. Subordinated bonds also, they're considered capital, regulatory capital, so that if anything happens to a bank or a financial institution, these particular bonds, on deeming that the institution is non-viable, they actually convert to shares. So they convert to shares, and you'll see shares is the lowest position in this capital structure. That's what's known as the first loss position. So they convert to shares to ensure the ongoing survivability of the bank. That survivability term is really important because if the bank survives, then the more senior debt holders will be repaid in full. But under the non-viable determination by APRA, subordinated debt converts to shares. So there is an underlying higher risk element compared to the other securities that sit above it. Hybrids have another interesting feature, and that is that interest payments can be halted and foregone. So if that happens, there's what's known as a dividend stopper, which actually means the shareholders or the company cannot pay dividends on the shares. So there's quite a decent incentive for the company to make those payments on hybrids. But nonetheless, if it's undergoing some financial distress, it can halt distribution payments, whereas in higher levels in the structure, the subordinated and the senior debt, if that were to happen, it would be a default event and there would be quite serious consequences. So hybrids have that additional risk, if you like. There's quite a few risks there and they're quite complex securities. If you've invested in them or are thinking invested in them, you must read the whole product disclosure statement. And I've read quite a few, and I have to say, even hybrids issued by the same banks have different terms and conditions. So it's really important to read and understand exactly what you're investing in. So the last level is shares, and they are the highest risk in the structure. And this structure actually works in reverse as well. I didn't mention that, but losses are taken from the bottom up. So the shareholders are in the first loss position, they wear the losses, and if a bank were to default, you'd expect the shareholders to be wiped out. And then the losses move up the structure as well. So you can see there's really a lot to take in here about risk and return and understanding where your bonds sit in the capital structure. Also, what value of securities sit underneath. And this is known as a cushion or a buffer, equity buffer. So how much has to be lost before you might be impacted by losses with your holdings. One final point with this diagram is that if you are always looking for the highest paying investments or securities, you would always invest in the shares. But as an analyst, over many years, different levels of this structure have been more appealing than others. So it's really important to understand if you're investing, say, at the subordinated debt level, what the senior unsecured bonds are paying, but also what the hybrids are paying. So it's really important to get a feel for risk and return right throughout the capital structure when you're thinking about investing in bonds. So what are the key risks? For me, the most important one is credit or default risk, and that is that a company cannot pay you interest or principal when they say they're going to. When you're investing, it's good to think about whether you can imagine the company being around in 5 or 10 or 15 years, or whatever the term to maturity of the bond is, and that will give you confidence in investing in that company. Now, if it does, for whatever reason, default, you may be paid some of your capital back and interest, you may be paid all of it, or you may be paid none of it. It really depends on that equity buffer in the structure and what assets the company has and the value of those assets on its balance sheet. Also, what someone is prepared to pay for them. So if you're thinking about it, a company and investing, it's a good idea to look at the what its assets are and if you think they'll retain their value. The second key risk for me is interest rates. Now, fixed rate bonds and inflation-linked bonds take interest rate risk, and that means when interest rates rise, those bond prices will fall. And if you sell prior to maturity, there's a chance you may incur a loss. However, if you hold to maturity and the entity still survives and it pays you your interest and your principal, you will not incur a loss. It's only if you want to sell prior to maturity. And of course, you actually don't really want even paper losses in your portfolio if you can avoid it. The third one is liquidity. Now, nearly all assets experience periods of illiquidity, and that is the lack of being able to sell quickly without loss of value. Now, in this case, the higher the risk of the bond, the greater the chance of illiquidity. So if you're concerned about illiquidity, you certainly would have an allocation to very low risk, high quality bonds in your portfolio, because they are the ones you could sell if you needed the funds. There are a few ways to invest in bonds. You can either invest direct in the over-the-counter wholesale market or the ASX, or through an exchange-traded fund or a managed fund. Now, I think investing direct is preferable because you have complete control over what you invest in. You choose the company or the entity, the term, the yield you're hoping to achieve, whether the bond's fixed or floating or inflation-linked, and you get the natural maturity. You get funds being returned to you at maturity. So I really like the direct investing route. The downside is to invest in the Australian over-the-counter bond market, and this isn't an electronic exchange. It's like a currency exchange where traders talk and find a mid-rate or an agreed rate to exchange the security. So you actually need to find a bond broker, such as Income Asset Management, who will trade on your behalf. The minimum size of a bond in the Australian OTC market is $500,000, which is out of the reach of most personal investors in Australia. But brokers such as IAM will buy those bonds and break them down into smaller parcels of $50,000 or more to invest, so it enables personal investors to invest in that wholesale market. I think it's ideal for self-managed super fund investors because they want total control and oversight of their investments, and investing direct gives this to you. You generally need to be wholesale qualified to invest in this way. Now, with ETFs and managed funds, it's a simpler product. You buy and there's a manager that oversees a pool of assets. Whether they are a passive or active manager, they oversee the investments and they take a cut for that. There are actually over 60 ETFs in the market and more than 150 unlisted funds available. There are many, many choices. They can cover specific sectors. So if you just want exposure to high yield or emerging market, you can find that with those funds. The manager, though, they have control of the investments. They choose when to buy and sell. They actually also choose when to distribute funds to you. It may be monthly, it may be quarterly, it may be triannually. you don't actually get that natural flow of income or the income stream. But also when a bond matures, the bond manager will reinvest those funds. So you lose the natural liquidity that you would get with investing direct. And I think that's a significant negative to investing in a fund. Also, investors think by investing in a fund, they don't need to do anything, which is true. You cannot do anything, but markets move, and even if you invest in a fund, you actually need to be aware of what's happening in markets, as you might need to buy and sell in any case. Also, just because it's listed, it doesn't mean that a fund is liquid. We have seen through distressed markets funds being frozen and investors shut out from getting their capital back. So, summarising, you can invest direct, which I think means you have better control and oversight of your investments, or you can invest through a fund where you take a more passive role, but you still need to be aware of what's going in the market, and you may still need to trade those funds. So let's recap on what we've learnt today. First, bonds are a legal obligation. Company must pay you interest and principal when they say they're going to, or else there are serious repercussions. There are many reasons to invest in bonds: diversification, reliable income, capital preservation, just to name a few. Bonds are negatively correlated with risk assets such as shares and property, and so can offset losses in your portfolio in a market downturn. There are 3 types of bonds: fixed rate, floating rate, and inflation linked. Now, the fixed rate and the inflation linked take interest rate risk, and this can be positive and it can be negative, but really important to understand when you're buying a bond what sort of bond it is. Now, bonds are always going to be lower risk than shares in the same company. As we looked at that capital structure diagram, there's actually 3 positions for bonds in that structure, and that's another thing to consider when you're buying bonds: the risk and return and what level you want to target. There are many thousands of bonds on issue globally in different currencies from different companies. We have foreign companies issuing bonds in Australian dollars like Volkswagen and Apple, so you can actually get some great diversification with bonds. One of the best ways to invest, I think, is by investing direct, because you have total control. So what are the next steps? I think fully understand this webinar first, and if you're not sure about some points, go back and view them again. But once you feel ready to learn more, have a look at the second video in the series, Expanding Your Bond Knowledge. You can sign up also to receive Income Asset Management's Market Insights newsletter, or attend one of their face-to-face sessions where you can ask an expert questions. Then request a model portfolio, open an account, and invest. Why Income Asset Management? You will get your own relationship manager who will deliver a very high level of service to you. You'll also access their unique research insights from their team. That's their job. That's all they do. They look at strategy and companies and entities to invest in. A little bit about Income Asset Management. They have more than 14 years experience. They're an ASX listed group with more than $3 billion in funds under administration. There are more than 25 staff in their capital management team, and they partner with Netwealth, Hub24, Praemium, PowerWrap and Macquarie Wrap that underscores their commitment to making corporate bonds more accessible. Here are Income Asset Management's contact details. This now concludes the presentation. Thank you very much. Have a good day.